Over the past few years, I've run simulations for hundreds of retirements, and I've seen ones with 4 income annuities for more than all of their expenses, to much smaller ones, to ones just to replace bonds in a portfolio. And with more modern annuities becoming more and more popular, a lot of the times dangerously, today we're going to take a look at 3 scenarios where they don't just sound good, but the math, the actual probability of success of not running out of money or accomplishing your goals in retirement using retirement software really increases. Let's get into it. The first is when your guaranteed/stable income is tracking to be less than your current expenses. So that's your Social Security, your pensions. If you can't live on that money alone, an annuity to bridge that gap between how much money you're going to need and how much money you are receiving can, in many cases, but not guaranteed, increase your probability of success. It can also make it much worse, which is why you have to run the numbers. Here's an example that I actually did a full breakdown on in another video, I'll link below, of a couple using exactly this strategy. So this was beforehand. This was before any annuities, just leaving the money in the market. There was around $500,000 for $3,000 a month in retirement expenses, trying to take Social Security at 62 as opposed to delaying it out farther. Currently, again, none of this is guaranteed, but using a Monte Carlo analysis and the retirement software, it projected their probability of success of 91%. Now, this is actually a very good number, and a lot of the times you're not even necessarily going to want to make changes. Sometimes you might make changes to actually lower this number so you can kind of push the limits a little bit more if you're willing to be flexible. But in light of just trying to get this number higher with different tweaks, what we did is exactly what we just said. So we added in an income annuity. He had $500,000 that was in the market there. So just using half of it was the test that we ran. We could probably play with the numbers a little bit more to get the exact optimal amount in terms of the probability of success. But we saw $250,000 staying in the market, $250,000 being deferred around 8 years until that income was actually turned on. And that was able to produce $31,700 a year for the rest of his life, not adjusting for inflation over time. Now keep in mind, one of the reasons that this is going to be able to work, and I'll show the changes here in a second, is because he had more time to delay this annuity out. The longer that we can delay the annuity until we actually turn on the income, the better guarantees, a lot of the times, the insurance companies are going to be able to offer us. Think about it this way. When you put money into an insurance company to use an annuity for income, they are not just keeping that money in a safe and locking it up until you need it and then giving it back to you. Same thing that banks do when they're able to credit you interest on, say, a high yield savings account. They're not just locking that money up and giving you additional money because they want to be charitable. Both banks and insurance companies are in business. So what they're doing with this money is they're taking it and they're going and investing it elsewhere. Whether that's bonds, loans, cash value life insurance, whether that's real estate, these are places where banks will keep their money, insurance companies a lot of the same. The longer that you tell them that they can for sure have your money until you're going to need it back, the longer you lock it up, kind of like a CD, the better guarantees they're going to be able to provide you for an extended period of time. Now that's the first point. The second point is that with the annuities that are deferred out longer, like one that let's say it's 8 years, is that when a lot of people get these at scale, so let's say 100 people buy this annuity that's going to be turned on in 8 years, and then they can receive this income with these great guarantees. Part of the reason, again, that they're able to give those great guarantees isn't just that they're able to go and invest that money in or in arbitrage. It's also that a lot of these 100 people that are doing this strategy actually end up deciding when they get to 8 years, well, you're also saying that I can get even more income if I delay it 9 years, or 10 years, or 11 years, or 12 years. Or, unfortunately, some people maybe forgot they even had the annuity and they just let it continue to go, and they say, I'm not even going to need this income, I'm already fine, a lot of things changed in my scenario, so I'll just continue to let it grow. And because of that exact scenario, where not all of these 100 people actually end up going through and turning it on in year 8 and end up delaying it farther and farther, and some end up passing away before they even turn it on, again, they can offer better guarantees because of that. So with that in mind, with this 8-year deferred annuity, we see the change goes from 91% up to 98%. So if there was really any sort of hesitancy, if, can I retire? Can I not? Should I work an extra year to get that a little bit higher? This should really seal the deal. 98%. Again, not that you necessarily want a much higher probability of success, but it shows the difference. The second scenario is the reinvestment touch. And what I mean by this is if you are going to turn on an annuity for income, whether that's immediately or 10 years into the future, and it's not going to adjust for inflation over time, which most of them do not. Sometimes it might make sense to actually buy an annuity that on top of, let's say, your Social Security or other pensions, is going to give you more money than you need for those starting years, let's say the first 10, but then after the 10th year, because inflation is going to keep rising, then at that point it's actually less than you need, and Social Security plus your annuity isn't quite enough, so you're going to have to pull from the market or somewhere else. In this case, if you factor in those first 10 years where you're receiving more money than you actually need for your expenses, and reinvesting the piece above your expenses back into some sort of strategy, we just used a taxable account. That's how we ran it. You could, of course, find ways to make that even better. But when you factor this in, running the numbers through software, a lot of the times, again, not every time, you got to check the numbers, annuities can greatly increase your probability of success. Here's another example that I did a full breakdown on in another YouTube video that I'll link down below. In this one, it was within a year. So we can see this was the current projection before the annuity. Just the baseline here, we see the probability of success as 87%. But if the market performed poorly, so a bad decade followed by moderate growth there, we can see that's the selection I have there. There's a little bit of an income shortage there in the last years if they were to live beyond 90. That's why the probability of success isn't 100, but a little bit lower, like 87. The change that we made was adding in an annuity, so it's $23,000 is what it would pay out, not adjusting for inflation over time, but he's receiving more money than he needs in those early years. So you can see here, this is the savings. So the 401k savings was before he was retired. Then after he's retired, in each of these has a specific year. Here's how much money it was going above the expenses he actually needed. We said, what if we put all of this money for a little less than 15 years into this taxable account? How would that affect things if we factored in, again, turning on the annuity right away, getting the money, but it's more money than I need, so taking the difference, putting that into a taxable account, and letting it grow until we're going to need it later once inflation has picked up and the annuity no longer covers all of our expenses on top of Social Security or other pensions. What would that look like? As you can see here, it actually, in the bad decade followed by moderate growth scenario, there's no red at the very end of the projection. The probability of success goes from 87% up to 98%. So that's a little over a 10% increase, 11% to be precise. Again, is this going to be the case in every single scenario? No, but it is one of those where it can make sense. The third and final scenario for this video is if you are mathematically delaying Social Security. Now that does not mean you are just delaying Social Security because you want a higher benefit. I am saying you are delaying Social Security because not just you're getting a higher benefit, but your retirement software shows you that your probability of success actually increases when you do that, which some cases it does not. It actually decreases even though you're going to receive more money. In that case, adding in a small annuity that's only going to pay out until you start receiving Social Security, which those do exist, can increase your probability of success. So a little example here, we have age 62 to 70, the annuity providing the guaranteed income. Age 70, you turn on the Social Security, and beyond age 70, there you have the higher lifetime benefits, and now the annuity is no longer paying out. That's a little setup in terms of how this could work. So I want to show you, again, an example here. This was someone who had around $720,000. If they took Social Security at 62, their probability of success was 82%. That's this number on the left here. If they took Social Security at 67, their full retirement age, their probability of success was 94%. If they took it at 70, it was actually lower than 94%, but higher than 82%. So in this case, it is going to generally make sense if they're trying to optimize their probability of success to delay Social Security until age 67. Part of the problem is that they don't want to wait to retire until age 67. So if they retire earlier, is there a way we could bridge that gap between taking the Social Security at 67 and when I retire with a stable income where I'm not too worried about the market being volatile. I'd rather opt out of that, have some peace of mind, and just know that stable income is going to be there until I receive my bigger Social Security check. The changes that we made, again, you can see right here on the left, that's the annuity there, paying out for just 7 years, with 350,000 of the 720 went into this 7-year paid out annuity. Then it completely stops. There's no money left. If he were to pass away early, a death benefit would pass on for the money that he did not receive. That changed things too. If he were to claim at 62, a 68% probability of success. But if he followed through on the plan of claiming at 67, the full retirement age, it goes from 94 to 98% probability of success. Not massive changes in any of these specific examples. It's not only about the probability of success though. There's plenty of other factors and reasons that you might get an annuity in the first place. A couple of those: bonds portfolio replacement. I mentioned that in the beginning. Whether it is replacing those bonds with something that's going to produce income, or something like a fixed indexed annuity just with a floor and a cap, where all you're really trying to do is not lose this money, but at least have it gain something, hopefully keep up with inflation, maybe beat it a little bit. That's an option. Another one, and I've mentioned this in some other videos, is using life insurance to, when you are actually filing for your annuity payments, taking it single instead of joint, but then paying the difference between single and joint into a permanent life insurance policy that has a high enough death benefit to where when the person receiving single passes away, the joint survivor or the surviving spouse would basically be able to take the lump sum from the life insurance policy, purchase an immediate annuity on themselves, and would actually end up in some cases paying much higher than if you had just taken it joint initially. So it can't even be a safer option. There's other benefits to that as well. So the probability of success increase also doesn't even just stop once you get the annuity. You can actually continue to make tweaks by using that strategy I just explained. And then the main one here, this is the main reason, if you look at YouTube comments, if you go on Reddit forums, asking retirees why they personally got an annuity, most of the time it's just that peace of mind. It's a bridge to pulling out of their retirement accounts that they've saved up in their whole lives, and it forces them in some way to get this income and to start spending. It's kind of a license to spend, if you will. And ultimately, that they know that that money's going to be there for the rest of their life, guaranteed. It does not matter what happens in the stock market. If it goes down 40%, they're still going to receive their payment. If it goes up 40%, they're still going to receive their payment. Some final warnings, because as I said, annuities are becoming more and more popular. It's very important to take caution with them. Not a universal solution. You've got to run the numbers. They're very context dependent, and analysis before action. Now that you understand how mathematically, when actually using retirement software, not just trying to make them sound good, when annuities might actually make a lot more sense than you thought of otherwise, or actually increase your probability of success. If you find yourself in a similar situation where you're looking for a little bit more peace of mind and security in retirement, you'd like these numbers checked for yourself to see if, hey, mathematically, would this actually put me in a better spot? Book a 20-minute quick consult with myself down below. I'd be happy to do that. And now that you understand that there are scenarios where annuities don't just sound good, but mathematically, using retirement software, we can actually increase our probability of success, of not running out of money, of accomplishing our goals, watch this video on screen now that shows the different ways to actually maximize your annuity payout after you've already got one, whether it's an annuity or a pension, because these small tweaks can make all the difference.